Finance for the everyday millennial. Hard-charging solutions. We provide an accelerant in the journey towards financial independence.
Welcome to Cassian with Cassian, the financial forum for young professionals. Today we're going to be talking about, you guessed it, finance, with my friend Dakota Hutkin. If you've ever wondered what it's like in the day of the life of a financial advisor, you're about to find out, because Dakota, he's been doing this for a little minute. After graduating from the University of Vermont with his bachelor's in economics and a minor in statistics, he served as a financial advisor and investment operations manager for a boutique firm in Boston, Massachusetts. He was also responsible for managing about $140 million in assets under management. He now works in the investment solutions division for Fidelity Investments, where he helps clients build out tailored financial strategies. I've been told to note that the thoughts, comments, and opinions that Mr. Dakota Hutkin is about to express do not reflect the opinions of Fidelity Investments and are the sole responsibility of Dakota. Also, nothing discussed today should be taken as personalized investment advice. All right. How you doing today, man?
Hey, I'm doing all right, Cassian. How are you?
I am well. So, can you tell us a little bit about what the day in the life of a financial advisor looks like? More specifically, what does a day in the life of Dakota Hutkin, the financial advisor, look like?
Sure. So I think this is going to depend based on what kind of firm you're with. But the typical day of a financial advisor is going to be full of client meetings. And if you're not meeting with clients, then you're trying to meet with clients or to prospect for new clients. And so there's a delicate balance that changes over the landscape of your career where, especially when you're starting, most of your time is going to be spent just trying to get in front of people and just trying to get them to buy in. So you're spending a lot of time prospecting, whether that's getting referrals, which is really ultimately the best method, and getting warm introductions through friends, family, or clients that you already have. Or whether that's simply just cold calling and everywhere in between. And I've been on both ends of that. And then as mentioned, the other side is on the actual client meetings. Depending on the kind of support that you have, you may be spending some time doing the defensive work and actually preparing for the meetings, building out the financial plans, building out really the presentation and how you're going to educate the client on what it is you're trying to do. So you may be spending some time on that as well. But if you've got a strong team built out, then the most efficient use of your time is either meeting with people or trying to meet with people.
I laughed earlier because you talked about warm network before you talked about cold calling. And I am so familiar with that process. I'm pretty sure folks are very happy that caller ID exists, because when they see my call, they're like, I already know. So that's awesome. I like to think that the best way to actually receive a client is through a referral. So how successful have you been from going from cold calling or warm networks to actually working with clients and then having those clients refer you?
Yeah, as far as like the success rate between like the touch point and making them a client, nothing beats a warm referral. I mean, especially in the business of financial advising, it's so personal, and you're putting a lot of trust into someone. And in a lot of cases, we're talking about a 60-year plus relationship that you're planning to build with someone. And the decisions that we make today regarding our investments, our insurance, and our broader financial planning, they're massive decisions, and we make one adjustment here, one adjustment there. Today in our 20s, this is going to compound for decades. So it's incredibly important. So being able to have that warm introduction, truly nothing beats it. I mean, if a good friend of mine that I trust and think highly of tells me that they've got an advisor that they trust and think highly of, I'm at the very least going to hear what they have to say.
Yeah, I mean, we're both more or less in the same space here. I love this because of the relationship building opportunities that are afforded to people in our profession. you're literally changing family trees, and it's really more than just selecting companies to invest in. People don't realize that there's a whole other component to financial planning. You've got insurance planning on top of retirement planning and investment planning. You've got estate planning. So yeah, I just really love to hear when other financial advisors, financial planners are talking about this profession as being one where you're building a relationship, and one where you're kind of leading with a teacher's heart. Because I think an educated client is one of the best clients, because they're asking more pertinent questions and you're able to serve them better. So yeah, I appreciate you for sharing that. The next question I have is, what do you most look forward to and least look forward to in your day-to-day?
I most look forward to the actual client interactions. And that's my bread and butter. I mean, that's why I got into the business. I've always really liked connecting with people and building relationships, and I've always, had a strong interest in financial planning and economics, and personal finance. And so to be able to marry the two and sit down with people and get to know them, get to know what's important to them, and help them solve these issues. And one of the things you mentioned was, the importance of education. It's incredibly important, especially in the U.S. is really all I can speak on, but the financial literacy of the average citizen is incredibly low. And there's massive barriers to entry because there's so much information out there. You don't know where to start. It's like drinking from a fire hose. And so it helps to have that teacher's heart, like you talk about, because, a lot of the initial meetings, a lot of time spent in those initial meetings are just educating on where they are at, and help shedding some light on where they want to be. And my job is to then help them implement the tools to get them there.
Yep. An infinite amount of options with a limited amount of resources. That's what we do. I am not a conspiracy theorist by any stretch of the imagination. I just want to put that out there for everybody listening and watching. But I do think that folks like Robert Kiyosaki and Grant Cardone and other people in this financial guru services type space are onto something when they say that our current education system is set up really to produce workers, not to produce entrepreneurs, the next generation of CEOs. And I think there's some intentionality about not increasing the level of financial literacy in K through 12, because I don't think our system is really set up to have people be financially literate. And it's kind of sad, honestly, when you think about it. Again, I don't claim that, our decision makers are intentionally excluding financial literacy, but it just doesn't make any sense to me why you wouldn't include financial literacy options in K through 12 at multiple points through K through 12, and then offer the course as, a college elective or something like that. Did you have any thoughts on that, or?
I mean, I agree with you. I think a lot of times when I'm explaining to people the difference between a traditional IRA and a Roth IRA, it's the first time that they've ever heard about it. Yet our retirement accounts are going to be the biggest pool of, tangible assets that we have come retirement. Yet nobody really knows what the difference is there, or the difference between, traditional contribution with Roth contribution if they've got a 401k. I think if we could start bleeding in this financial literacy into the school systems earlier, we'd be, the average American would be much better off.
Yeah. How many times have you had a client who is knowingly or unknowingly engaged in traditional contributions, but not taking the deduction on their 1040?
I haven't seen that.
I've seen it too many times. I'm like, the sole point of going traditional over Roth is to take the deduction in the year of the contribution, and they don't do it. Just that one piece of information that I provide them alone is worth my fee. But we definitely have to focus on ways to increase financial literacy across the board, K through 12, through college, and when people enter the workforce, there should be, some sort of a program offered by your HR department that's providing information like this to you, so you can make the best, most informed decisions for yourself and your family. So, all right, I'm going to throw some statistics and data at you. According to Indeed.com, the average salary for a financial advisor is somewhere between $60,000 and $80,000 a year. And the average student loan debt for people graduating with a bachelor's degree in economics is about $19,000 a year, according to educationdata.org. Do these numbers resonate with you at all?
I mean, they're averages. Hey, that sounds like the averages for an entry-level financial advisor position. Granted, if you're managing your own book of business and you're making 1% the revenue is 1% of the assets you manage. If you're bringing 60 to 80,000, that's not that great. Also, I mean, I graduated college with 75,000 in student loan debt, so I would love to have that 19,000.
Yeah, you're above that average.
That 19,000 sounds nice, but I mean, there's a lot of different roles that can be classified as a financial advisor. Some of these roles you are fully 1099 commission only, building your own business from the ground up. And in some of them, you're a salaried associate financial advisor with a major firm working with an existing book of business, and may only be working with clients, under a certain asset level until you have more experience in the role. So I think it's hard to say. I don't fall in either of those ranges. So for the income level or for the student loan. So, and I'm a financial advisor.
Gotcha. Would you say, based on what you know now, that the profession is one that people should be interested in joining? And what I mean by that is, when you look at other professions, like the legal profession, the medical profession, there are clearly needs, more so in the medical profession as opposed to the legal profession. But our profession, people are kind of like, I could just open a Webull account. I could just, open a Vanguard account and then dollar cost average until I'm able to achieve whatever the number is that I need to retire. People, I think, may not be valuing the advice that comes with the financial advisor professional. And so what do you say to people looking to join this profession, but maybe they're surrounded by people who don't really find value in it?
Sure. I think you'd be surprised how many people do find value in it. There's a lot of different ways, a lot that I have to say on this question, and it can go many different ways with it.
Let's do it.
The first one being, a lot of my friends have reached out to me as the market, to date is down, 20 to 23%. And they're wondering what they should be doing. They don't need to be doing anything if we're talking about their long-term dollars. We expect there to be market declines, and if anything, this provides a buying opportunity for your long-term assets. But why, if we've made a long-term plan and we're expecting some volatility in it, why are we making short, nearsighted moves to move ourselves out of the market, right? And so I forget who did this study, so what a great study quote I'm dropping. But the majority of the return that a financial advisor gives to their clients is in the behavioral coaching. Because I probably, if you understand basic index investing and how to diversify among large cap, mid cap, small cap, international developed, international emerging markets, maybe a little bit of commodities, maybe a little bit of fixed income, depending on your risk tolerance, then the only additional advices that I'm going to be able to help with and be able to provide, I'm going to be able to provide some foresight, because I've got some clients who are 60, 70 years old that are encountering issues that you haven't touched yet in your 20s or 30s. But also I'm going to help to provide that planning and the behavioral management. So the largest driver of return from a financial advisor has come in the behavioral management, where it's easy not to touch your stocks when the market is crushing it. But if we're going to go through a 2 to 3 year period where the market is down and volatile, that's tough to stomach. I mean, it's one thing not to look at your account 1 week or 2 weeks, but when every single day the news is berating you with negative information about your money, and it's your money that you're going to retire with, that you wanted to buy this house in, X amount of years, you wanted to pay for your kids' education X amount of years, that eventually it takes a toll. And I personally know people that made drastic mistakes during this market decline. So that's that's one thing to think about. The second is the opportunity for financial advisors in the market. And as the baby boomers start to pass away, there's going to be a $30 to $70 trillion wealth transfer from that generation to the next generation. That provides a massive planning opportunity for people that now have multiple millions of dollars that they've inherited, or even if we're talking about a couple 100,000 or tens of thousands, whatever the number is. People are going to be inheriting lump sums of money, and now they're going to need to make a plan with that money. And maybe that plan, it doesn't always make sense for, well, I'll just throw it into my, my Weevil account and putting it into a target date fund. It's going to help to have somebody on your side to be able to plan with. And to be able to capture even a fraction of a percent of this 30 to 70 trillion over the next couple of decades, I think just provides a massive opportunity for financial advisors.
I'm so happy you brought up that statistic. This is going to be a massive wealth transfer. And I think people entering the profession need to realize that whatever their current surroundings are is not representative of the overall U.S. market, right? In order to be successful in this business, you do not need to have hundreds and hundreds of clients. I would argue you should not have hundreds and hundreds of clients because you wouldn't be able to serve them effectively. So yeah, it's really encouraging to hear you say that.
Do you keep dreaming about when you'll be able to pursue your passions? It can be challenging to turn that dream into reality while providing quality care to your patients, addressing your student loans, and living a comfortable life. I'm Cassian Nunez, the CEO of Rhino Invest, and I'm here to share a better way, the Rhino way, which will make you financially independent sooner so that you can start to do more of what you are actually passionate about. Just to be clear, financial independence is achieved when your passive income exceeds your expenses, freeing you to pursue your passions, be it the ER job you love, helping your community through volunteer work, or becoming a world traveler. In other words, you are no longer trading your time for money to keep food on the table and pay your bills. So, what is the Rhino Way? It is the roadmap to achieving financial independence using the 4 guideposts of real education, investments in performing assets, no bad debt, and oversight of those assets. Our Rhino account provides products and services as a pathway to achieving your goals at a pace you set and in an environment with other like-minded people, all focused on lighting a fire in their financial plan. Becoming a Rhino will increase your financial IQ by making you familiar with the concept of risk and return, the different asset classes available for investment, and how you can take advantage of those options immediately. You'll have access to curated courses, online calculators, wealth guides, checklists, and your own net worth tracker. All this and more with your Rhino account. So I invite you to take the first step towards realizing your goals by opening an account today. Thank you for joining me, and I look forward to working with you.
I think most people, when they think about financial advisor, financial planner, wealth manager, whatever term you want to use, they think that they already need to have assets, right? And it's not until they have a net worth of X amount, hundreds of thousands, whatever it is, they're not concerned about it. It's not until they have that, they're just not going to be concerned about it. What do you tell someone who's 22 years old, just graduated with their bachelor's of science in nursing. They have all this student loan debt, and they're just entering the workforce about the services that you provide. Would you take somebody like that on as a client? What do you tell that person?
I think in the role that I'm in right now, I don't think it would make sense in that kind of relationship for them to be paying any amount of fee to be working with me. And I don't have a great, you know, I think my services are better suited elsewhere. But with that said, I can give them a rundown in a 10-minute conversation, which I will do. And I've done it with all of my friends as we were getting out of college and continue to do this. Just some of the foundations of what they need to focus on. I'll tell them a few things. One, if you've got credit card debt, eliminate that. Two, save 20% of your income. You know, contribute 7 to 10% in your 401k. Use some money to pay off your student loan debts. If your interest rate is 5% or below, I wouldn't pay necessarily more than the minimum amount, because you can put the delta of that into an investment account. Then open up a brokerage investment account. Mind you, once you also have 3 to 6 months worth of cash in an emergency fund. If you want more than that, that's up to you. But there is an opportunity cost to that, because the inflation data just came out today for the past month. It's at 8.2%. And I know the cash to bank account isn't earning 8.2%. And so we have to fight that. So let me just run that back again. Pay off credit card debt if you have it, and use your credit card ultimately like a debit card. Spend the money that you have, not that you're expecting to have. Two, build that emergency fund. Have 3 to 6 months worth of expenses in cash, and that's your buffer. Three, make sure you're contributing at least enough in your 401k or retirement account to receive your company's match, and then some. Try to get up to roughly 10% if you can. And then after that, save what you can into a brokerage account. If they just set up those foundations, for the most part, they can just set it and forget it. And I tell them to call me back when they need to pick an investment fund. And ultimately, I'll probably just tell them to put it in an S&P 500 index fund. And then we can get a lot deeper into diversification if they'd like to. But if they're doing all of that in their own personally managed account, it's going to be probably too difficult for them to allocate it correctly each time. You know what I mean? So I'll just tell them S&P 500 index fund, and that should be fine. If they have any short-term goals to buy a home in the next 3 years or 3 to 5 years, then I'll show them either a highly rated corporate or bond fund, or just keep it in a money market account, and mostly just in cash. You follow those couple things, you'll be fine. And then call me back once you're there, and maybe it makes sense to have a managed investment account. But that is the foundation that just needs to be built.
So that's excellent advice. Not so shameless plug, because this is my show. I would tell that person to open a Club Ronald Plus account and increase their financial literacy and IQ. We have a course, it's called Entrepreneurial Personal Finance, where we provide calculators specific to the student taking them. And at the end of the course, they're actually able to get the framework for an investment strategy. So it gives them a budget, because I think really the first thing that people need to be aware of is how much money is coming in and how much money is going out. Everything is great when you know how much money is coming in and how much money is going out, and making sure that you have a positive cash flow. And then from there, you can really start to look at all the different things that you need to be doing in terms of having that emergency fund, purchasing performing assets, tax planning. All that stuff is going to come much later once your net worth is higher. But yeah, educating people on all the different options that are available to them, and then matching them based on their risk tolerance with what they should be investing in, and what they are going to have the highest probability of success investing in. That's what I would tell that 22-year-old, is to open a Club Ronald Plus account. But thank you for that answer.
To say.
Thank you. Exactly.
Yeah, I meant to say open up a Club Ronald Plus account. Never mind everything else that's there. But no, you bring up a really good point. You've got to understand your cash flow before you can understand how much you can save. You need to know what's left over, or if you need to be reducing your discretionary expenses. It is so incredibly difficult to cut your expenses and cut the amount of fun that you're having because you realize that you're not saving 20%. I mean, one thing you can do is do that incrementally so that you're saving 1% more each month or over whatever time period. Which is also important to remember that as you get raises, you are also proportionally increasing your saving while you also get to proportionally increase the amount of fun that you have. But it's difficult to go the opposite way. We just don't work like that psychologically. So the earlier that you can start that off the bat, the easier it's going to be.
Awesome. Thank you. Moving on. What are some of the, and this question is for the folks aspiring to enter this field and become financial advisors. What are some of the employee benefits enjoyed by people in this industry? People thinking about joining may not be aware of some of the advantages afforded to people in this industry. Obviously, I'm not asking you to reference the Department of Bureau and Labor Statistics, rules and regulations around our industry. I'm really more asking a major firm like Fidelity Investments. What are some of the options that you guys enjoy?
Sure. So Fidelity actually has some of the best benefits in the industry, if not just nationwide for any company. They match 7% in my 401k. On top of that, they add 10% a year to my 401k, and that's profit sharing. They also they give bonuses regularly that are not terribly difficult to hit your targets to get those bonuses. They're paying nearly $200 a month towards my student loans. They have you get like 12 free mental health counseling sessions a year. There's a phone line I can call into to just get professional medical advice. It doesn't, I don't have to pay for that. It's not a doctor's visit, but if I want to just call in and get some advice on something, I can do that. They have a wellness reimbursement where each year they'll reimburse me 50% of up to $600 worth of expenses, whether that's gym memberships, whether that's some kind of health and wellness app. So that's $300 a year in reimbursements that I get there. As a first-year associate, you get 23 days of paid time off, which is a lot, and that goes up the longer that you stay there. What else? They have, like when I signed, I got like a free sweatshirt when I started working. That's cool. Right?
Yeah, that is cool. We like free stuff.
And they have they also recently had an event in Boston where it was like all employees could go to it. There's food, there's drinks, there's fun, there's speakers, all that. But they recognize that most of the people in the country aren't going to be able to come to Boston. So you can go on their website and click this link that says, send me the boardwalk in a box, which was like it was called like Fidelity Boardwalk or something like that. And then you can pick out like $45 worth of stuff. There was like cookies, there was candy, there was salsa, hot sauce, there was like a white noise machine, backpacks, like nearly anything out of the sun, you name it, and they shipped to your house of stock.
That's awesome.
There are discounts on work from home equipment that you can purchase. You like HelloFresh, they send like meal prep delivery stuff. You get like discounts there. It's just like a whole slew of discounts for working there. That is not a comparable example to most financial firms. Fidelity is unique in that space. They spend something like $1 billion a year just on these employee benefits.
Nice. That is impressive. That is impressive. For folks looking to enter this industry, go ahead and go to fidelity.com. I'm kidding. But
they also provide with an HSA that they contribute $750 a year to, depending on your salary level.
So that people really don't understand what HSAs are, health savings accounts. We do have a video on it, so if you want to learn more about it, please go into the library. It's called the Rhino Invest Library. And we have a video explaining everything about health savings accounts there. But we are approaching the top of the hour. And so I want to ask one more question before we get to the quiz. So the last question, again, going out to the folks looking to join this industry, what are some of the barriers to entry for becoming a financial advisor?
I would say the biggest barrier to entry would be yourself. A lot of these firms are hiring entry-level financial advisors. You have to do the work to get your Series 7, your Series 66, maybe your Series 63, maybe you need your insurance licensings. All of that will be paid for by whatever firm you're with. So the biggest barrier to entry would be, yourself. And depending on what firm you're with, if you're going to have to build your own book of business, that's a mentally very difficult thing to have to put yourself out there to friends, family, and try to get introduced to everybody that they've ever met. So I don't think there's that many barriers to entry. I think anybody can learn this stuff.
Awesome. All right. Thank you. We will now move into my favorite segment of the show. So you think you're smarter than a rhino. The purpose of this segment is to answer as best you can 6 questions. 5 questions will constantly change. And these are questions that if you are a Club Rhino Plus member, you will know the answers to. And the 6th question is going to stay the same. So the first question on So You Think You're Smarter Than a Rhino is, what is the maximum contribution you can make to a Roth IRA in 2022?
Geez, I haven't looked it up. It's probably 6,000 still.
It is, or 6,000.
Okay, that hasn't changed then.
It hasn't. Do you know what the catch-up contribution amount is and what age you'd have to be at in order to take advantage of the catch-up contribution? This is about
7,000 and 55 and over.
Yep. All right. What time frame does an investor have to own a stock in order to be taxed at the long-term capital gains rate instead of the short-term capital gains rate?
A year and a day.
Bam. What is the difference between being rich and being wealthy?
The difference between being rich and being wealthy is not just having money in the bank, but having a plan, having a managed cash flow, because I could be making $500,000 a year and my expenses are $490,000 a year. Having a transition plan for my wealth so that, I've got life insurance and I can ultimately escape estate taxes and probate. I would say that that's the difference.
So I don't know. I'm going to review the tape and determining whether to give that to you or not. But this is our definition. Being rich is measured in money and being wealthy is measured in time. And so if you're rich, you can make $250,000 a year. But like you said, if you have $250,000 a year or $300,000 a year in expenses, you're not really rich, right? You just make a lot of money. Versus being wealthy, you could be wealthy and only make $50,000 a year, but you make it passively. You're no longer trading your time for money. So if you make $50,000 a year passively and your expenses are less than $50,000 a year, you are no longer trading your time for money. You're considered wealthy. And so that's how we define the difference between being rich, measured in money. You're still trading your time for money. Wealthy, measured in time. You are no longer trading your time for money. You have passive income coming in.
Sure.
All right. These questions get harder still. When thinking about real estate investment properties, which one of these things is not a depreciable asset or item? Which one of these things is not a depreciable item? Number 1, the roof. Number 2, the HVAC system. Number 3, plumbing. Number 4, raw land. Or number 5, all of these things are depreciable items.
Raw land is not depreciable.
Correct. All right. Folks, do not try to depreciate land. All right. You cannot do it. You will get caught. Okay, cool. In what order should someone invest for retirement between traditional, 401k match, and Roth?
They should take the 401k match first because that's free money. Traditional and Roth can be a little bit subjective because it depends on your income, your tax rate now versus what you expect it to be in retirement. But if I have to make a blanket statement, I would say Roth and then traditional.
That is correct. I mean, the answer you were going to give is also technically correct because it is subjective. However, we say 401k match first, it's free money, then Roth, then traditional, because we are banking on people being wealthy. And we believe that they are going to be in a higher tax bracket. And so we're already planning for that. And then the last question, my favorite question, what does the Rhino acronym stand for?
Oh, I don't know. It stands for real estate, investing, and new opportunities.
I love the effort. A for effort. That is not correct. It stands for real education, investments in performing assets, no bad debt, and oversight of those assets. And so that's what we are all about here at Rhino Invest. We're all about educating people, spreading the gospel of financial literacy and IQ, talking to people about the different types of assets, performing and non-performing, and why we want you to invest in performing assets. Getting rid of bad debt, you talked about it at the beginning of the show. Credit cards have to go. Terrible debt. Student loans, terrible debt. But there are debts that are good, like a mortgage, especially a mortgage that's on an investment property, because that would be a performing asset. So we also have a video on that too, the difference between good and bad debt. And then oversight of those assets. You can't engage in oversight if you don't know what it is that you're looking at, which means you have to increase your financial literacy so that you can, if you're working with a financial advisor such as yourself or a financial planner or somebody in this field, you know what questions to ask about your portfolio. So yeah, thank you for playing. I appreciate it, man. I appreciate your time. I hope you have a great rest of your day, and I look forward to talking to you again.
All right. Thank you, Cassian. Go right now.
Thanks, man.